the first episode, the discussion will focus on herding and FOMO behaviors, as well as macroeconomic factors contributing to these patterns and a historical example. Herding refers to individuals making decisions based on the majority's actions or choices rather than independent research or judgment. For instance, selecting a restaurant because it is popular without prior knowledge of any part of its menu. FOMO stands for fear of missing out. It describes individuals reacting to perceived opportunities when others appear to benefit financially, which may lead them to invest without sufficient analysis. Low interest rates are a macroeconomic factor often associated with herding and FOMO. Lower borrowing costs and reduced returns on savings and bonds can encourage investors to seek higher yields by increasing risk across various asset classes. This behavior sometimes leads to concentrated investment trends. The term TINA, there is no alternative, is used to describe this dynamic where low rates encourage both increased risk-taking and a search for higher returns, potentially resulting in a cycle of rising prices and heightened FOMO. Easy liquidity is another contributing factor. Stimulus measures or quantitative easing from central banks and governments increase available capital and credit for investments. With greater liquidity, markets can experience rapid movements, and investors may act quickly and follow prevailing trends rather than relying on their own analysis. Technology stocks in the late 1990s illustrate the influence of behavioral and macroeconomic factors on market dynamics. This chart compares the Fed funds target rate in blue, which reflects interest rates, with the M2 money supply in white, indicating market liquidity, and the NASDAQ composite price in red. The first marker corresponds to August 1998. Liquidity had been increasing steadily for the 2 years prior, accompanied by lower Fed funds rates. It's important to note that today's interest rate range of 0 to 5% differs markedly from historical norms. In the early 90s, rates exceeded 8, and rates near 5 in the mid-90s were considered stimulative for that period of time. From the initial inflection point in 98 to the market peak at the second marker in early 2000, the NASDAQ surged nearly 240% over just 18 months. This rapid ascent led to the price-earnings ratio nearing 200. PE ratios are a metric used to assess index valuation. As the Fed resumed raising rates, liquidity growth declined, and the bubble burst in March of 2000. The NASDAQ subsequently declined by more than 75%, reaching a trough in October 2002, with the PE ratio dropping closer to 28. During the entire span from August 98 to October 2002, the NASDAQ ultimately fell 25%, ending below its starting value despite substantial gains during the early period. This episode is a clear example of how behavioral and macroeconomic factors intertwine to form and deflate speculative bubbles. Herding behavior and fear of missing out, or FOMO, prevailed in late 98, even as the NASDAQ's PE ratio approached the high 80s. Lower interest rates and increased liquidity propelled the markets into the early 2000s, until subtle changes in these macroeconomic indicators precipitated a downturn. Overlooking fundamental drivers such as interest rates and liquidity often illustrates behavioral biases impacting investor decision-making. Thank you for your time today. Please join us for our next episode where we will discuss overconfidence and the Icarus effect.